Hello and welcome back to Bunnex Investment Group. This is going to be the last part of our course, which is how to predict the forex market. So in part one, we actually discussed about how to catch the high or low of day. Then in part two, we talked about how to catch the high or low of the week. Then in part three, we talked about linking 2 weeks, how to see the market reversal from 1 week to another. And if you haven't watched those ones, you can go and refer them on our channel. Then in today's video, we are going to be talking about the quarters theory. Since I highlighted it in the first lecture, that we are going to talk a little bit about that concept in our fourth lecture. So this is basically a how to predict the market reversal in indices, commodities, and other trading assets like shares, bonds, etc. So before we jump into the whole video, please check out our free signals Telegram channel. The link is right below. And if you haven't done so, click the subscribe button so that you'll be notified each and every time I upload a new video. On that note, let's jump right into our today's content. So this is US 100, which is basically NASDAQ in other terms. It's a meter or a gauge of the top 100 companies in America, the performance of them combined and plotted on a chart. So it's a very high paying asset, but you really need to know what you are doing if ever you try to trade this instrument. So quarters theory is basically a theory that was designed by someone some years ago. I'm not so sure his name, but it basically says most reversals happens at whole numbers, which are basically a quarter derived from a data. So let me put into action what I've said. The first thing that you do when using the quarters theory is to basically go on the chart that you wish to analyze, and this is how it looks on H1. And the first thing is to see where the price is coming from. As you can see from this point, this is the lowest point, and it shows that price is coming from the 12,000 handle. 12,000 handle. So that's the first thing that I will do. After seeing that it's coming from the 12,000 handle, I would look for a whole number from that handle. In this case, the whole number is 12,000, and I can only see it if I go on the H4 time frame. So let me insert the 12,000 handle and draw a horizontal line on that value. So I'm going to input 12,000 on that horizontal line. So there we are. So sorry about that, let me correct the value. 12,000. Right. So from 12,000, that becomes our data. 12,000 becomes our data. And from that, we start to increment with 500. So from 12,000, we go to 12,500. We are now in the process of building the quarters. In this case, we are using these values because that's the scale of the instrument. So there we are now at 12,500. If we increment again with another 500, we'll have 13,000. But if we are doing this system on normal pairs, it means we will have a 1,000 pip interval. And by having a 1,000 pip interval, we basically use the same concept of finding a whole number where the price is coming from. Then segment that 1,000 pip range and into 250 pips. So For NASDAQ, it uses a different scale, and we are incrementing with 500. So from 13,000 we go to 13,500. Then from 13,500 we go to 14,500. Sorry, 14,000. So after doing this, we can see that we now have 1, 2, 3, 4 quarters. And the theory states that price reversals are imminent at each quarter level. So price reversals are imminent at each quarter level. So what we basically do is to try to find confluence at these quarter levels. After marking out like what we did, we can now go on the H1 so that we may see confluence of the market on these levels. So as you can see, I've marked this, and by confluence we mean a reversal setup at these quarter levels. So this was basically a level that we could actually anticipate before it actually happened, and a reversal setup was issued at this point, and the market went down to another quarter level. From on this quarter level, a reversal setup was also issued, and the market did this. Then after that, the market passed through this quarter level. In some instances, the market will come to retest and issue a setup to drop, but in this case, the market makers actually decided to issue a setup at this point. Then on this quarter level, which is 13,000, they issued another setup. So these quarters have names like major quarter, minor quarter, and so forth, but it's not necessary for me. This is the exact concept that really works for me. So as you can see from this point, the market went up, and so we could have this entry, another entry, and another entry, right? At this point, we can see that the market actually issued another retest at this quarter level, and it went up. So our next thing is now to see how the market is going to react at this quarter level. Is it going to issue a setup below this quarter level, or is it going to break and then issue a setup to continue going up? We do not know. We only react to what the market has given us. So that's basically what we do on the quarters theorem. There is nothing fancy about it, or nothing that is so special about this theory. It's basically marking out the chart first using a datum that you can determine by seeing where the price is coming from, then actually increment using a certain value depending on the instrument that you are analyzing. In pairs it works, but there is a lot of choppiness in pairs. So I've seen, and from my past experience, I've seen that this works properly on commodities, indices, and so forth. So before you use any strategy, you need to backtest it first. You need to see how it performs in your operations before you actually start putting real money on it. So that's what we had in our today's video, and we have come to the completion of our course, which is how to predict the market. And be sure to check out new courses as they come on our channel. On that note, thank you for watching. Like and subscribe and share with someone. It might help a brother or a sister.